Welcome to In Depth for a closer look at what is making mining headlines in the Americas. Nuclear fuel producer Cameco says long-term uranium contracting has been weak so far this year, but all eyes are on key markets, China and India. Mining Weekly's deputy editor for North America, Lizzo, who is based in Toronto, Canada, joins me to discuss the issue. Welcome to the show, Lizzo.
Hi, Martin.
What is Cameco saying about long-term uranium contracts?
Well, as you know, the uranium producers sell their products broadly in two ways into the market. The one way is through the spot markets, it's immediate sales or short-term sales. And then the other way is these long-term contracts that they sign with utilities. And what Cameco is saying is that because utilities are broadly pretty well covered for their needs over the next coming years, but basically the long-term contracts are typically signed for uranium delivery at least 2 years after the contract is finalized. And so because these utilities are reasonably well contracted, they're not under pressure to go out and sign contracts. And as a result, Cameco, they presented their first quarter results this week. And what they said is that they've seen a pretty relatively slow long-term contracting this year. And as a result, the company actually said they've brought down their forecast for long-term contracting this year. They originally was calling for 150 million pounds, and they've actually brought it down quite sharply, all the way down to 100 million pounds for 2010.
And what about the spot market? Is it doing any better?
Yeah, at the moment the long-term contract prices, there's a bit of a discrepancy, and there has been for a while. The long-term contract prices are sitting just below $60 a pound for uranium, and the spot market price is just somewhere a little bit above $40 a pound. And the spot markets, even more so than the long-term contracts, is very discretionary at the moment because these utilities are well covered. In fact, a lot of them have been stockpiling for a better part of this decade. And so as the CEO of Cameco puts it, at the moment buying on the spot market is very discretionary and supply is rather less so.
And how is Cameco responding to these trends in the market?
Well, first of all, I should point out the one key factor in especially the long-term contracts is these two key markets, China and India. They're expected to really drive demand for uranium going into the future with the big nuclear builds that they're doing to supply electricity to their populations. And so while they, until now, Cameco tells us, they've really been focused on securing the uranium just really for the initial uranium for the initial cores that they're putting into the plants. But so they haven't been looking at signing these long-term supply contracts. But once they do come into that market, then that's going to be a pretty significant turning point for long-term contracting because they're really expected to drive the demand going forward. Cameco, even though the short-term picture isn't that rosy, Jerry Grandi, the CEO, he's been talking for quite some time about this nuclear renaissance that's going to drive demand going into the future. There's at last count there were 53 nuclear plants under construction around the world, and Cameco is actually expecting that there are going to be as many as 90 new nuclear reactors and in operation within the next decade. That's what he said this week. So as a result, with this good-looking long-term or medium long-term picture, Cameco is really trying to push and get production up as much as possible. The company is expecting to produce around 21.5 million pounds this year, but is calling for production of as much as 40 million pounds. So that's almost doubling just by 2018. And where this production is going to come from, the company is increasing output at its Big McArthur River mine in Canada, its Inkai mine in Kazakhstan. It's going to be increasing production. It's got some small operations in the US. And then beyond that, it's got two development projects, quite significant development projects, Kintyre in Australia and the Millennium Project in Canada. But all those aside, the biggest contribution, Martin, is going to be coming from the company's big Cigar Lake project in Canada. And that's going to account for some 9 million pounds of that 40 million pounds a year.
And finally, the Cigar Lake project, is it now back on track?
Yeah, as you know, it's I suppose they should have been careful about naming the project after a lake, but because the mine it's flooded during construction in 2006 and again in 2008. It's a huge high-grade deposit, but it's really just been significantly delayed. Cameco recently, just a couple of months ago, finished dewatering the mine and now is able to send teams underground to have a look, assess the damage from it's been flooded now for the couple of years, and then to start the repairs to prepare for construction. And Granby, the CEO, he said he was down there pretty recently, and he said it's actually looks surprisingly good. So the company just needs to, it's still assessing what it needs to do to get the mine ready to restart production, and to restart construction, and then production they're calling for in 2030. Although they say they're going to be looking for any way they can to accelerate the project.
Thank you very much, Lizo. That was Lizo speaking to us from Toronto, Canada. Join us again next week for more news and insight on mining in the Americas. I'm Martin Joaquin in Johannesburg. Thank you.